Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is Christopher Ecclestone, Principal and Mining Strategist at Hallgarten Company. Chris, welcome back to Kitco.
Thank you.
Now, we have a money-focused edition this week, that's how the news trickles out. But first, I think we should talk a little bit about silver. Silver's broken through its $35 per ounce ceiling and is holding ground above $36 per ounce. Chris, the silver crowd have been waiting for this moment for a lot of time. What does it actually mean, breaking through the $35 and staying above it?
Well, the silver crowd, of course, live the dream of over 13 years ago when 12 years ago when silver briefly hit $50 an ounce. And without the support of the Hunt brothers either, that was an earlier surge. So, they've had constant doubts about where silver could go before it sort of comes under attack, because, of course, the silver crowd, well known for their tinfoil hats and their conspiracy theories that someone is trying to take down their favorite metal. Why exactly, I'm not sure. Certainly, if it was a monetary argument, you'd prefer to sort of like take down gold than take down silver, but who knows? But, it does have an industrial tailwind, which certainly helps it in a way that gold does not. But gold, of course, is over the last couple of years has been hitting new highs. But silver at 37 is not a new high. 50 is the old high. So they've still got a ways to go. But when you look back at the charts of that time, which I think was 2012 or 2013, the chart was like a rocket to the sky and then a rocket to the ground again. So it was very much a spike. And this is sort of like consolidating. And that's a good thing. I'm not a tech analyst by any means, or technical analyst, I should say. But certainly a slow rise in any metal is better than a sudden rise, because sudden rises are almost always followed by a slump. And in silver, we have this other dynamic that a lot of silver, and people don't seem to realize this because they think silver just sort of like comes out of silver mines, is actually a byproduct of lead mines. And lead mines are actually on the way to follow the dinosaurs because of the switch to electric vehicles, because the main usage of lead is actually in lead acid batteries. And most lead acid batteries at the moment are recycled. So there's, with the rising percentage of autos being EVs, there is actually no requirement for new lead. And so lead mines are in financial trouble, and they're certainly not being developed. So that augurs a bit poorly for silver, unless the silver price is at a level that it can make up for the fact that the lead price has really gone nowhere in years now.
Well, Chris, let's follow up on the price aspect. If sort of 12 years ago, silver was $50 per ounce, gold was, I think, around $2,000 per ounce. Gold is up, let's say, 50% since then. So can we expect silver to increase another 50%, $75, $100 per ounce, or is that just, wishful thinking?
Well, if we're going all historical, silver over the long term, and I'm talking centuries here, is said to have a ratio of like 15-1 with gold. And we're a long, long way from getting back to that ratio to gold. I think it's like 60 or something at the moment, or maybe even higher. I mean, it's not as bad as a few years ago, but it's a long way before we get back to the historical average. And there's no reason why it shouldn't go back to the historical average.
Now, you mentioned the silver also is propelled by the industrial demand, but if the silver price goes much higher, will that industrial demand stay, or will that sort of fall away? The metal just becomes too expensive to use in industrial applications?
Well, it's industrial applications, many, But the ones that are really driving it are solar panels. And there's no weakening in solar panels. I don't have a great outlook for wind turbines because there's quite a lot of turning against wind turbines all around the world. But solar panels are on the rise. The amount of adoption that could take place there, not just in the first world, but in the global south, is immense. I mean, you go to Spain, a country with so much sun, and you hardly see a solar panel. It's totally crazy. So the potential for solar panels to have a lot more upside is way, way better than wind turbines. And wind turbines have just sort of like become really unpopular, and they don't have a very long lifespan either. There are a number of them that are being scrapped because they're falling down and things like that, getting blown down or breaking up, is quite extraordinary. So as long as we see solar panels going up, the demand for silver will go up, just as in the old days. As long as photography was getting bigger, silver was getting bigger, until it wasn't.
Okay, well, we will continue to follow the rise and the fortunes of silver on Digging Deep. Now, interesting story here. Stablecoin cryptocurrency company Tether Investments has bought a 33.7% stake in Elemental Royalties as part of its broader vision to, quote, enhance the utility of digital assets backed by real-world value, unquote. Tether paid 121.6 million Canadian to buy shares from long-time Elemental shareholder La Mancha, about $1.55 per share there. It also bought an option for $3.4 million to acquire Elemental shares owned by Alpha One, which if exercised would bring its total holding to 47.7%. Tether agreed to pay between 52 and about 53 million to exercise the Alpha One option. Tether has a market capitalization of about 155 billion US dollars. Chris, very interesting transaction this. A royalty company like Elemental, which has a market cap of 376 million Canadian, perhaps makes an unusual choice for the execution of this strategy. As while precious metals generate its revenues, it does not produce or physically receive any precious metals. What's your thoughts on this?
I love the deal. I love it, mainly because I hated La Mancha in Elemental. I liked Elemental very much for many years, and its other constituency, which was Altus. They were put together. La Mancha ended up on top, and La Mancha were very poor custodians as far as I'm concerned. So when I heard that they were out, I didn't know who it was that had bought the shares, but I didn't really care, just as long as La Mancha were gone. Then when I saw that it was Tether, extra light bulbs came on, because this is a very interesting transaction. What we have here really is sort of like an empty vessel with an enormously large market cap, backfilling with real assets. And at the size of that company, it could make a bid for Barrick if it wanted. It could fill itself up with gold and silver producers and still have stable coins to spare.
Now, I take on board your point. I think Elemental Royalties has been a very interesting and dynamic company in the royalty space. It's been, it's done a lot of work to consolidate the sector. And in line with your comments, Chris, it does seem that if the CEO of the company, Frederick Bell, wants to continue that consolidation and acquisition spree, he'll certainly have a key investor that would presumably want to back that. And of course, there's a lot of consolidation that many people think is possible and is very necessary in the royalty space. Do you see this as a ticket for Fred to be able to continue to consolidate?
Oh, absolutely. Now he's got way deeper pockets. The Egyptians, who are really the people behind La Mancha, were not forthcoming with much in the way of money, unless it was just to sort of like do a creeping takeover. These other guys at Tether, I really think they're a bit of a blank slate as far as mining and royalties and gold and silver are concerned. So they're going to, I believe, essentially leave it to the professionals to run the company in a way that the meddling of La Mancha will be a thing of the past. And that will mean that they'll bring presumably some good ideas to Tether and then present them to them, and either that will persuade the management there to cough up more money or not. I find it a bit intriguing, though, that the actual, one thing is buying a stake, like Tether did, a very large stake. The other thing is acquiring an extra stake and not being forced to make a full bid for Elemental Royalties. So we may still see that come, because frankly, regulators should be saying, okay, this is over 19.9%, you've got to make an offer to all the shareholders of the same amount of money. Now, whether the shareholders accept or not is a different matter, but they should all be offered the same deal that La Mancha was made if the stake is more than 19.9%. And buying yourself for one stake is then like an extra trigger to that, because it shows that Tether are accumulating. Yes, I'd like to see it. I'd like to see how it evolves. As for actually the rationalization of the royalty space, much of that has already taken place. There was a burgeoning of these stocks, this type of stock, around 5 years ago. And since then, it's been a process almost unremittingly of consolidation. There are not that many players that are worth having at the moment. And some of them are overvalued. So we shall see. I don't think that Fred Bell is someone to do dumb deals.
Well, I would certainly agree with you there. And your earlier comments have sort of triggered some more light bulbs for myself, because also in the royalty space, you've got a couple of companies that are tied with financial institutions, and they have a sort of symbiotic relationship. The financial institution does a financing deal and gets or adds a royalty for the royalty company as part of that. I'm thinking here of someone like Endeavour Financial and Empress Royalty. So if Tether's, in your words, potentially it could bid for Barrick, could it bid for bigger gold producers and then put royalties on them for Elemental?
It could make a bid for BHP. It just shows the craziness of the world at the moment. But Tether's probably, their management has sort of realized that they need to backfill the company with real assets that underpin the valuation, that are not merely dollars, because people are buying stable coins to diversify away from dollars, not to be told, well, each stable coin represents so many dollars, because you're not getting away from the dollar there. So this is an easy way to actually access precious metal assets, besides buying, say, an ETF or something, that without having the nightmares of actually having to mine stuff and think about mining stuff.
Perhaps a bit of backstory here is that in the United States, Tether and other stable coins have been under pressure from regulators that are looking to limit what they can do, the ability to issue stable coins in the US, and pushing them to have real assets to underpin what they do. Also potentially throwing money about this week is the US Export-Import Bank, EXIM, which signed an LOI with private copper developer Pathfinder Tonopah for $896 million to potentially support the development of its copper and molybdenum mine near Tonopah in Nevada. In April, EXIM issued a similar LOI for up to $825 million to Ivanhoe Electric for its Santa Cruz project in Arizona. Copper projects require large amounts of capital to develop, and it seems the US government is serious about getting more domestic copper supply. Chris, is this a sensible way for the US government to help copper developers come into production and therefore increase US copper supply?
Well, I see EXIM Bank LOIs as being something that you can shop around to get real money, because they come with all sorts of conditions And many of the miners are not in a position to meet those conditions, so they can go to these banks and say, okay, no, to this bank in particular, and say, okay, well, where's your checklist? We've ticked all the boxes that you've got, and then Exim Bank will say, okay, well, there's nothing fundamentally wrong with this. It's in the US, etc. But the things that may be fundamentally wrong with any mining project are that they're dependent upon the mineral prices. And to a certain extent, there's a fad for copper at the moment, and this memo has gone out from the White House that they love copper and they want to see copper in the US, and they have tariffs on copper and all sorts of things to foster US industry. This is just sort of more wood to that fire. Whether a check at some future date will be signed for $868 million or whatever the amount was is a different matter, because the companies only get part of the financing of the projects. I don't know how large the capex is with that one. So they've got to raise the rest of the money either through other debt, which means that they come out of the gate with enormous amounts of debt. And we've seen copper miners go bust from too much debt on downswings in the past, and or they also have to raise an awful lot of equity, and that then just flattens their stock price. So it's a bit of smoke and mirrors, and it's all good. The industry runs on smoke and mirrors, so it's a quality smoke and mirrors.
Okay, I think we'll be getting into this a little bit later with another news item that we'll be covering. But before we do, interesting, of course, the copper price is a key factor in the ability to make money and finance and service debt. With gold and silver prices grabbing headlines, pretty much throughout this year, the copper price has slowly, perhaps almost imperceptibly, climbed back up to about $4.50 per pound at spot, closer to $5 per pound in futures. Chris, what has driven this slow incremental growth in the copper price, and why has it seemed to have escaped everybody's attention?
I think it's more perceptions in the trade of potential long-term shortages due to the lack of big mines. The big mines that we have in the world now are pretty much legacy mines. Some of them have been going for ages. I think Bingham Canyon in Utah has been going since like 1917 or something. And many of the Chilean mines have been going for 4 or 5 decades. You've had a new mine in Mongolia, Oyu Tolgoi, but not a lot of new mines of the mega category. So we're now becoming dependent upon the mid-sized mines. And a lot of the mid-sized mines, because copper was in the dustbin until quite recently, these mines are, they're developed up to the resource stage and they have feasibility studies and things like that, but they haven't started construction. Hardly any. I always raving about the potential of copper in Argentina, but the copper mines in Argentina, of which there are like 6 big ones in the mid-tier, none of them are under construction.
Yeah, so they're a good few years out. Okay,
yeah.
Let's switch tack again. With prices for gold, silver and copper riding high, bought deal financings seem to be on the increase as investor appetite slowly returns to the mining space. Aya Gold and Silver has entered into one of the largest bought deals announced in recent weeks, 100 million Canadian, upsized today to 125 million. Arizona Sonoran Copper announced a 45 million Canadian bought deal. Fireflies Metals, $26 million Canadian. Other deals, Talon Metals, Newfound Gold, Goldshore Resources, Dolly Varden Silver, and I could go on. In fact, as of June the 5th, the past 2 weeks have seen about 12 bought deals for an aggregate $190 million US. And so far this year, there have been 37 bought deals announced for a total of $688 million, according to Orient data. Chris, why are we seeing bought deal financings coming back onto the page?
Well, I find it very ironic because you go to Toronto or Vancouver and you've got everyone is sort of like weeping about how there's no money. And yet these deals, you've just reeled them off there, are happening. And they're not only happening, they're getting upsized in almost every case. And so what are the people crying poor in Toronto talking about? And I think what they're talking about is the fact that the investors are very much discriminating between producers and developers on one side and pure explorers who are spinning their wheels on the other side. And the pure explorers, unless they're run by people who have a history of making the jump over to development, just look like people who are coming up with yet another resource, yet more drilling, to maybe find a buyer. But they're not going to produce anything themselves. And the market is rewarding those who produce or plan to produce. Those who just, bloviate about their next drill campaign, sitting there rattling their tin cup on the street corner on Bay Street, and they're not getting any donations either.
I agree with you. I think it shows that there's a certain confidence returning to the sector, because obviously the banks and the brokerages that do these, they're backstopping them, and so they obviously seem quite confident that they can place the stock. And I guess for the companies, the bought deals tend to be for higher amounts, higher quantums of money. So presumably that means they can.
Yeah, we're not talking about bought deals in the $3 million category here.
Yeah.
So they can. And one example, Aya Gold and Silver, the first one you mentioned, it's already underwater. Because bought deals can turn around and bite you on the behind. You make the deal too big, and you don't bed it down with real long-term portfolio holders, but rather transitory investors who are just trying to make a quick turn. If they don't make their quick turn fast enough, they spill it out the door, and then the stock price can head south rather fast. And that will be something that if you get a run of bought deals that had poor aftermarkets, then the bought deals will once again evaporate.
Now, this leads us nicely into our next item. Perpetua Resources last night announced a bought deal, $300 million US, and a concurrent 100 million private placement with long-time big investor Paulson & Co. That's going to help fund the equity component of their $2.2 billion development at its Stibnite Gold and Timony project in Idaho. Now, of interest here perhaps is this financing. This bought deal was at a hefty 20% share price discount compared to its closing the prior day, and certainly compared to those we've just mentioned, which averaged about 8.5% discount. So a big ouch and a haircut there for Perpetua Resources shareholders. Chris, it also appears that the company is going to seek to raise 200 to 250 million by a net smelter return royalty in gold or a gold stream. So perhaps double ouch there. Has Perpetua just got a whole lot less interesting for investors, Chris?
No, it's a unique position. It's the antimony there, and the fact that they're talking about a gold stream and a hefty NSR possibly is a sign of the times that the gold is regarded as less important than the antimony. Because frankly, this stock spent a long while, and I've covered this in the past. They spent a long time sort of in limbo because the capex was too large, and there were environmental issues and various other things. And it didn't look like Paulson were putting up any extra money, because Paulson had effectively become trapped in Perpetua as the largest shareholder, and even at one point they were the management as well, which wasn't their thing. And they've, over 3 years, they've sort of distanced themselves from being in the management. They're on the board, but they're not actually the CEO or the chairman in the way that they were back in the past. But they weren't also throwing their own money at the thing, because they already were up to the eyeballs in the stock. I think at one stage they owned more than 50% of it, or more than 60% of it. So that was a very hefty position. And so they're actually, going along with the crowd. And the stock has been a big riser on the back of antimony, and it has not been rising because of gold. And if Biden or Biden lookalike had been re-elected, the EPA stuff would have still been circulating around it. But it's been made a priority project now, so it looks at least that environmental problems are off the table. But I can say that in the time that I've known the project, the capex has sort of risen 50%. And it's in a very sort of challenged location in very narrow valleys in Idaho. So, isolated place, lots of nature all around. It could end up having even more capex blowouts. Hopefully not, because the thing is that even if it gets produced, even if it starts to build a mine tomorrow, it's not going to have a mine for like 4 years, and that does nothing to solve the antimony crunch at the moment.
Now, the project's got a lot of positives. You mentioned some. The company recently applied for $2 billion of US government financing. I think that was also from US Exim Bank. So it does seem quite an outlier that there's a 20% discount there. And obviously the share price has fallen just over 20% this morning as a result of that. Most other bought deals are around that 8 to 10% discount to the closing price the day before. 20% seems to be quite a onerous discount.
You should look at it from a different point of view, which is that the management, the management's a hedge fund, or the largest shareholder is a hedge fund, and their friends and fellow travelers are in there as well, and they know when a stock is overvalued. If you look at the chart of Perpetua, it's gone too far, too fast. So they say, well, should we struggle to get financing at the current level, or just say, hey, it's gone too far? Let's do a discounted deal, create a new base, and then it can move up again from that base. But trying to preserve an overpriced level that has been set by a few swiveled-eyed retail is a big mistake. You've got to do the deal where it's a good deal for everyone, except for the swivel-eyed retail.
Well, that's a very good point, and thank you for pointing that out, Chris. Now, many people think a company, you mentioned about the bought deals being upside. Many people think a company should take all the money it can while it is available, rather than perhaps raise a modest amount in the hope that successful work programs will enable it to raise at a higher share price in a year. Talisker Resources certainly think so, having increased its non-brokered private placement from 3 million Canadian to 14 million due to investor demand. Chris, what's your view of this? Take all you can when available to not have to refinance for a couple of years, or try and play the market?
The mining industry, people get suckered every time by saying it's a boom, it will go on. So if I don't finance today, I can finance tomorrow, in 6 months or a year. And then they have the rug pulled out from under them. They end up going into some sort of down tick in whatever metal they're pursuing, or the general market goes into a down tick, and they end up running out of cash, going bust, and somebody else picks them up for a song. So very smart move here. And I think we need to also, I know Talisker very well, and I like the company enormously. It's one of the few sort of smallish cap companies that's on the verge of big production. So I think it's starting to get out there that that is the case. And so I wasn't surprised that they were able to upsize, because maybe the word is getting around there. But other juniors that might have a 20 million market cap and try to raise 2, they're not going to find that they're getting 6. Because there's some fundamental flaws with the great unwashed of the mining market. There are far too many companies doing far too little. If there is a finite amount of money out there, and I'm not persuaded that there is, because from these deals that you've just reeled off, you have to be something special. You have to have a USP to attract the money, or else you're just another one of the vast heaving, hand-waving crowd on House Street.
I think one thing that's, thinking more broadly on this, Chris, it's speaking to CEOs as I do and as you do, it's amazing that so many of them don't finance when their share price is cresting at high levels, or even worse, perhaps they get talked out of financing. And then, as you say, the market moves, their share price goes, the metal price goes, and they're left unable to finance. Always say, oh, we're concerned about dilution. But if you're dilution's only going to be worse further on most of the time, I think. And
it's interesting on that point that it's not the retail who is saying don't do the financing. It's a couple of strategics or someone who's got a 19% stake or 15% stake saying, oh, no, don't finance now. Do it higher up. But those people are, when ultimately the stock goes down for whatever reason, or the whole market goes down, they've said to the company, don't finance now, but when the company comes around needing money, are they prepared to put in? They're prepared to put it in 50% down from where it is now. And yet they're saying, don't finance now. What is that about? It's, if a financing is well done, it doesn't have to damage the stock price. If you put all the stock with flippers, then you're making a rod for your own back. But if you place it with good institutional long-term holders or good retail long-term holders, high net worths and things like that, your stock does not necessarily have to go down the drain because you do a chunky financing that makes sense. But it must make sense.
Absolutely. Now let's move on to some of the people that write those checks. The VanEck Gold Miners ETF, which is the world's largest gold mining exchange traded fund, that's going to undergo a major change in September by changing the index it tracks. The ETF, which has about 16.4 billion US in assets under management, will switch from the NYSE Arca Gold Miners Index that it has tracked since inception to the Market Vector Global Gold Miners Index. Quite a mouthful there. In addition to rebalancing its holdings, the switch will also see the ETF reduce the number of stocks it holds from about 58 to 49. Another disturbance in the mining investments universe will happen tomorrow, June the 13th, when a proxy vote takes place that will likely determine the future of the 70-year-old 700 million US closed-end ASA Gold and Precious Metals Fund. Saber Capital, founded by Boaz Weinstein, is a hedge fund with a history of engaging in activist campaigns in the $250 billion closed-end fund space, taking a significant stake before advocating for changes to the board, management, and/or investment policies. ASA Fund has been an early institutional investor in companies including Aya Gold and Silver, G Mining Ventures, Orla Mining, Atex Resources, and it participated in the recent recapitalization of America's Gold and Silver. In a recent webinar, Merck Investments, one of the fund shareholders, proposed, he said the scarcity funds of this type likely contributes to the widening valuation gap between development stage companies and producers. The ASA board has also received a proposal rumored to come from one of the mining industry's largest investors to inject over 100 million of new capital into it. Chris, why is it so important for the mining space to have closed-end funds like ASA?
No, it's not. There are two issues there. One is the VanEck thing. So if you're one of the 9 stocks that's going to get booted out of the current index, run for the hills. If you're one of the shareholders in them, because they're going to be big sells. All of those type of funds are very backward looking because they're looking back 2 or 3 years ago at what were the major sort of like moving and shaking stories then, rather than the up and coming gold and silver stories, because those gold and silver stories don't make it into the index until they've already happened, and by then they may be ready to go over the hill. Then if we look at the closed-end funds almost always have a discount, and the discounts get sort of bigger and bigger. And when you've got a choice like going into the VanEck ETF, or you've got a closed-end fund that may be sort of a liquid as well as being at a discount, certainly the liquidity is almost endless in the VanEck fund, Whereas for a closed-end fund, a mining fund of a few $100 million, you may not be able to sell a decent position on a day. So it ends up just being something for tiny retail to indulge in. And then you also have the issue of do active managers in the mining space make more money than just playing pin the tail on the donkey by running an index tracker? And I don't think there's a really great history of portfolio investment in mining that has paid off. And inevitably, a closed-end fund relies upon the quality of the managers, or the flukes of the managers more than anything else to get it right. More wrong often than not.
Okay, taking a step back, Chris, as the pool of mining investors continues to shrink, to what extent does that change the structure of the market? With fewer specialist funds, does it make it unlikely that gold companies can reach the valuations they achieved in the last cycle?
No, I don't think so. I mean, look at Aya. Aya ended up massively overvalued, and I still believe it's massively overvalued. So you could get overvaluation if that's what you want. It's out there. And I'm not sure, after all the bought deals that you just spoke about, that the market's as bad as people say it is. We need to discriminate here between the Canadian market and the Australian market, because the Australian market is very robust because it has the super funds. And if Mark Carney does anything during his reign, the vital thing for making Canada great again would be to actually mobilize pension monies into a super scheme like Australia has, and then provide an enormous impetus to the mining companies that are listed in Canada. Because as you're absolutely right, the number of Canadian institutional investors is very poor. It's totally denuded. You do not hear of Ontario teachers taking a big stake in Talisker Resources, and yet they should be. But big institutions like Ontario teachers would prefer to buy an office block in London or Berlin than invest in a mining company. And so those few legacy institutions in Canada are not pulling their weight. So you need to go back to the super solution, which is super funds. And, the Canadian market could be as robust, if not more robust, than the Australian market if it made this leap.
I hear what you're saying. An increasing number of CEOs I speak with say they are contemplating doing a secondary listing, a dual listing in Australia on the ASX to be able to get access to some of that action you just talked about. Now, let's finish up with a bit of political risk. Just when Ecuador seems to be getting on track through the recent election of pro-mining President Daniel Noboa, his government intends to implement a new mining tax to cover the cost of inspecting and regulating mining projects, seeking to raise an estimated $229 million. The country's mining chamber said the proposed values are unfeasible and in some instances would likely exceed the project's exploration investment. Chris, it seems that one step forward for Ecuador and several back.
Yeah, Ecuador has a history of shooting itself in the foot, and then in the other foot, and then in the head. And it's going that way again because, the number of live and kicking mining projects in Ecuador that need inspection, you could virtually number on the fingers of your hands. So why do they need $227 million a year, I'm presuming, to go and inspect them? Sounds like the tax is gouging. It could probably be 1/10 of that. And that would get you a whole fleet of inspectors who could go out and do whatever they're supposed to do. 227 million looks like it's just a hidden revenue generator for boondoggles and corruption. So I'm not persuaded. I mean, you know, that Ecuador had 10 lost years, and it's had 5 years of, you know, back out of the penalty box, and it looks like it's throwing itself back into the penalty box with glee. Why? It doesn't make sense. It's crazy.
Yeah, I think I would agree with you there, particularly as Ecuador's got a sliding royalty regime, which at these price levels means, you know, depending on the company and the project and its investment agreement with the government, they're paying royalties of anywhere, you know, 5, 6, 7% at the moment on gold and copper. On the positive side, the government said it planned to reopen the mining cadastre, which is the mining database where you can apply for concessions, soon, and to incrementally increase opening it throughout the year. But Chris, I guess that begs the question, given the taxation thing we've just mentioned, will anybody bother to apply for concessions, given that there's this jump in taxation coming just around the corner?
Yeah, I think there will probably, because, you know, in many countries, the actual applying for licenses is pretty cheap. You know, you can get a lot of land for $1,000 or for $5,000. You know, they're cheap to keep and hold on to and sit on them and do nothing. You know, I have a bigger beef all across mining administrations around the world that they allow too many sitting license holders who are doing nothing to hang on to licenses and just sort of like regard them as you know, something they can put in their sock drawer for a rainy day, and it shouldn't be that way. So if they manage the reopening of the cadastre properly, they should attract quality names. They had quality names before they scared them all away, so maybe some of the quality names will come back, or then new quality names. But, you know, it's vital. I mean, you can't have your license process closed down and just say, well, it's all the legacy guys and no one knew. Because then you just end up with the legacy guys. And the legacy guys, you know, in many cases, you know, just deadbeats. Good riddance to them. Let's take some licenses away from deadbeats.
Well, I think that's part of the aim of the new tax, to enable the government to do more fiscalization, to see who's actually doing work, and more importantly, see who's doing the work that they were promised, that they promised they would do when they were awarded the concessions 10 years ago. This one's not finished yet. I think there's a lot of lobbying and appealing in process in Ecuador, so we'll certainly be coming back to this in the coming weeks, I would assume. Chris Ecclestone, thank you very much for joining us today. It's been wonderful.
Thank you.
And to our viewers, of course, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.